Hi. Can you imagine investing your hard-earned money into a corporation that you thought to be promising? People invest their money every day into companies that they think are going to do well in the stock market, hoping to reap the benefits monetary down the line. Well, imagine you invested your hard-earned money into a company that misrepresented itself financially, and all of a sudden you saw the money that you worked hard for shrivel down to pennies on the dollar, all because this company lied about what they were generating in terms of income. Well, ladies and gentlemen, that's why auditing is so important, especially for people like us, investors on the outside looking in. My auditing teacher at Rider University worked as an internal auditor for Tyco, a security systems company. He talked about the need to have proper controls in place so that fraud could be prevented, and he was speaking from a first-hand experience. Tyco did not have a proper audit run by PricewaterhouseCoopers, the accounting firm they used, and the internal audit team also did a poor job at recognizing fraud. As a result, he saw the stock he owned in the company shrivel down as he lost thousands. Auditing corporations and businesses properly is necessary because it aids in preventing fraud and allows investors like us to make informed decisions by confirming representative financial statements. The first thing I would like to discuss is corporate fraud. Auditing is needed to help prevent and/or uncover corporate fraud. According to the New York State Society of CPAs CPA Journal, corporate fraud continues to be a pervasive problem. The Association of Certified Fraud Examiners reported in 2006 to the Nation on Occupational Fraud and Abuse and estimated that a typical organization loses 5% of its annual revenues to fraud, or about $4,500 per employee each year. That's a lot of money. Just look at a company that has 1,000 employees and multiply it by $4,500. Wow, that's an astronomical amount of money. Auditors try to measure fraud through the audit risk model. According to the Journal of Business and Public Affairs, the audit risk model explains the relationship between audit risk, inherent risk, control risks, and detection risk. Audit risk is the risk that the auditor gives to an inappropriate audit opinion when the financial statements are materially misstated. Inherent risk is the susceptibility of an account balance or a class of transactions to misstatement that could be material, either individually or when aggregated between the misstatements in other balances or classes, assuming that there were no related internal controls. The control risk, on the other hand, is the risk that a misstatement that could occur in an account balance or a class of transactions that could be material individually or when aggregated with misstatements in other account balances or classes and would be prevented or detected and corrected on a timely basis by the accounting internal control systems. Further, detection risk is the risk that an auditor's substantive procedures will not detect a misstatement that exists in an account balance or a class of transactions that could be material, whether individually or when aggregated with misstatements in other balances or classes. In addition to the audit risk model, an auditor also utilizes a risk assessment to identify the risk of fraud within the corporation. According to the Journal of Business and Public Affairs, risk assessment is viewed as a task that directs the auditor's attention to factors related to inherent and control risks, the risks we just talked about. The principle behind the concept of an audit risk model is that if the inherent and control risks are high, the detection risk and the audit risk should be lower. Frequently in practice, the level of acceptable audit risk is established by the audit firm, and the same level is used across different audit engagements in the same industry. Auditors will then typically assess the levels of inherent and control risk at the statement level and at the account balance level. Not only do auditors are on the lookout for corporate fraud, they are also on the lookout for material misstatements in financial reporting. Auditors give an opinion about the financial statements of the corporation they are auditing in an audit report. The American Institute of Certified Public Accountants says that the audit report identifies the financial statements audited in an opening, which is an introductory paragraph. They then describe the nature of the audit in a scope paragraph, what they did in the firm to audit the books, and express the auditor's opinion in a separate opinion paragraph. An opinion as to whether the financial statements present fairly in all material respects the financial position of the company as of the balance sheet date and the results of its operations and its cash flows for the period, then ended in conformity with the generally accepted accounting principles. The opinion should include an identification of the United States of America as the country of origin of those accounting principles, for example, accounting principles generally accepted in the United States, which is GAAP. Well, auditing is important to prevent corporate fraud and verify financial statements that the corporations present to the public. Auditing is important because without it, fraud would be more prevalent, as would material misstated financial statements, which would result in ordinary investors like me and you losing our hard-earned money. And when ordinary investors like me and you lose our hard-earned money due to fraud and material misstatements in financial reporting, you lose the faith of investors. And if you lose the faith of investors, an economy can't grow. And if an economy can't grow, the nation itself is doomed.